Jacobo, what's going on, man? I'm glad to be here with you.
Thanks for having me, brother.
I'm excited. We're going to be talking about some fun stuff, acquisitions, e-commerce, real estate, investing. So let's dive into it. Are you ready for going from operating to being all in into investing, all in into funds and real estate?
That's what I've been working on, man. The natural progression from first starting an e-commerce brand, starting it from scratch. So I know your model is acquisitions, right? But when I started, I was just launching products, testing, seeing what would work, but also failing, right? And there's a big risk when you start a new business because you have no proven demand, there's no proven business plan, and you're just testing. Right, so I think it's the statistics. It's like 7 out of 10 businesses fail, right? So when you start a business, you have all that risk. You have that 70% chance of actually failing, right? And then the natural progression now to where I'm at, where I'm actually acquiring businesses that have an underlying asset, which is real estate, which makes it a lot easier to get financing for, because they can basically underwrite the asset and lend you money based on that. And this for me has been game changer, right? Because now I'm also leveraging the fund. We raised capital. I'm not only using my capital, which starting out it was just me with the 10K I started my business with, and now being able to pull other people's money and leverage it into something bigger.
Absolutely. So basically you started college, startup, e-commerce, you grew that e-commerce, you learned the ropes, a lot of lessons, took it to then Airbnb, which we'll unpack a little bit of that. And then now you're investing, and we're going to expand on what that is. But I think the cool thing that we were chatting, a couple of weeks ago is like you said that there's an evolution on the mindset going from like, I got to build this thing. And now almost like we've reached that part down, the quadrants, you got like employee, self-employee, business owner, and investor, and you're navigating those in a different way. So tell us a little bit more about the e-commerce, what that was, and then the Airbnb next.
Yeah, so the e-commerce business, it was a wedding gift brand, and I was 22 years old. So at this point, I hadn't even been to a wedding, but the data said this was a good business, and I'm trying to make some money, right? Trying to make some quick cash, and that's why I started this e-commerce brand. I'm 22, freshman in college. And at that point, I didn't know anything about business, but in the end, it ends up working out, scale it to over 7 figures, and I'm able to get an exit from it. From there, I start looking into, all right, what else can I do that I can leverage my same skill set, which was digital marketing. I knew how to basically rank and launch products on a platform such as Amazon, and the Airbnb algorithm, it works the same. It's a similar marketplace where it's based on the search intent of that guest, right? So you're able to use different strategies like SEO, listing optimization, split testing, and other marketing stuff to basically position your property in the top of the first page. Mm-hmm. So when I found out about how similar the Airbnb and the Amazon marketplaces were, I'm like, all right, I'm going straight into that. Plus, I was looking for something that had real estate as an underlying asset because I wanted something that had a hard asset. Because when I was in the e-commerce days, I had all this inventory, and sometimes my competitors or my own suppliers would copy my products, and I was sitting on thousands and thousands of units of these aprons or cheese boards that I couldn't sell anywhere else. Like, try selling that on Etsy. It's going to take you years, right? Because Amazon is just so big that there's really no other marketplace to offload inventory if it's not selling well. So there's big risk in product-based businesses when you're managing all this inventory. And I didn't want to have any product-based businesses. I wanted to have real estate because, say anything happens with Airbnb, I can long-term rent the property, find a long-term tenant. I can live in the property, or I can sell it. There's always going to be a market for an asset, for a house, right? So that was the natural progression I made.
Wonderful. And then one of the things that you were sharing was the nuance about the Airbnb business, and you build a portfolio on that one. So tell us about that. You decided, all right, I can either start from scratch again with Airbnbs. You started differently this time. You say, I can leverage other people's money. I can build a fund, and tell us a little bit about what you did.
Yeah. So in the first Airbnb deals, I didn't do the fund model. I started with my own capital that I had from the e-commerce venture and started scaling that with my own capital. The good thing is with real estate, you can get a loan. So you put 10%, 20% down, and the bank will finance the rest, right? So you're able to go a lot further with your own capital through leverage, right? It wasn't until I got contacted by a private equity fund and they were wanting to merge and do a joint venture to really scale out the portfolio that I started learning about the private equity world, raising capital, and using other people's money to scale quicker, right? So that was, at that point was when I really started getting into it, learning, all right, what do investors require? How do you raise capital? How do you structure a deal? And how do you leverage that? Now, fast forward a little bit, and I ended up selling this portfolio to this private equity fund. They ended up acquiring my Airbnb portfolio, and that's when I'm now in my third business venture, and I'm looking for acquiring businesses, right? I wanted to get into business acquisition because of this same principle that we just discussed. I didn't want to have to test a business model myself and have to launch and test and do and strategize and see if it would work or not. Instead, I wanted to buy an existing business that already had income and already had proven demand. And at the same time, I wanted to have real estate as an underlying asset. And this is when I find the boutique hotel space. I don't know if you want to go into that now or if you should unwrap something else.
I think even when you and I were talking, it's like, hey, real estate. First of all, it sounds boring, but it's the business been around forever. And it's still like, there's all this incentive, like you mentioned, tax incentive. There's like all these different collateral benefits of having real estate. In any way or shape or capacity that you see it, it's always going to be beneficial to have real estate. However, even some of the guys that were talking a couple of weeks ago, the biggest thing with real estate, especially for our generation, was like, well, that's for like older people, right? Like e-com and Airbnb is faster. Like you get to do it, it's there. Versus like real estate is about compounding and like all this stuff. So how did you ended up saying like, this is the vehicle? If you have something like, all right, I can run an ad, I can do Amazon, I make a sale, versus like here, Airbnb is a little bit of that, but all the other ones takes a lot of work. That was my perception, but you're seeing it differently, obviously.
Well, real estate's slow depending on what asset class. And that's the thing I love about real estate is you got self-storage, multifamily, strip malls. There's so many verticals in real estate that it just depends on like what asset you pick. Yes, if you pick, say, long-term rentals or multifamily, it might be a slower play. But if you get into the Airbnb space, like you're getting cash flow. And that was one of the reasons why I went into Airbnb, because it's not your slow real estate, $100 a month. Like you're making thousands off these deals. You're getting cash flow, plus you're getting all of the other real estate benefits, which are all the tax benefits. So you get all the accelerated depreciation, which you can use to offset any other business income. So if you have an e-commerce company, if you have any other business, you can offset that income with real estate. So I always tell any of my other entrepreneurs friends, like you need to be holding real estate as part of your investment strategy, because you can be using a lot of the depreciation and tax breaks to actually offset your business income. So depreciation, but you're also getting the appreciation of the asset, which we'll go into in a bit. But residential, you can only hold and wait for it. Now in commercial, you can actually force appreciation based on the income the property's generating, which we'll get into that in a second. But yeah, you get all these benefits and also the cash flow. So real estate can be slow or it can be fast depending on the market. Now, boutique hotels, it's basically Airbnb on steroids, right? And I'll give you the reasons why. First, you're buying an asset that is way bigger. You get the economies of scale, and it runs just like a business. The reason why I decided not to continue doing Airbnb was because, one, short-term rental regulations. They're only getting worse. You look in New York, you look at California, you look at all these places, and you can see the trend.
In Canada, it's also like pretty bad right now.
Everywhere. Barcelona, I think, is going to ban short-term rentals. So reason number one, regulations are not on your side. So if you're ever doing a business where you're seeing like the sign on the wall, it's like regulations, like you don't want to be caught on the bad side of that. So regulation was a big one. But the second reason was I've always started all my businesses with an end in mind to exit them. And what I found was the limitation with Airbnbs was when you buy a residential property, right, you cannot force appreciation. Meaning I buy this property today for $1 million, right? And let's say that asset is cash flowing every year, say $500,000. When I go to sell and there's a buyer interested, when the bank comes in to appraise my property, they don't care how much it's making. They see that as only as a house, and they're going to look at what the properties in that neighborhood sold for, and that's the value of your asset. So I don't want to be in a business where I don't control the future, where I don't control the appreciation, right? You're in business acquisitions, you understand this, right? But in residential, I have to sit on that asset and wait for it to appreciate. If it does appreciate, I don't know the market conditions. I can't control that. So that was a huge limitation and factor on why after I sold my Airbnb portfolio, I didn't keep doing Airbnbs. But what I did find was boutique hotels. Now, boutique hotels are super unique because it's basically commercial Airbnbs. But when you have a commercial asset, now it has a hotel license. So regulations don't impact me. Even if they ban short-term rentals, that's actually good. They're removing all that supply from the market. Hotels get all that extra demand from guests traveling. Travel is not going to change because they ban short-term rentals. So hotels actually benefit from regulations. But the most interesting part of this is hotels are valued just like a business. So if you have a hotel that's making $100K a year, right? And say the market cap rate, which is the way you value commercial assets. In business acquisitions, it would be a multiple. So the cap rate is just like the multiple, right? So an asset that's doing $100K a year, if that market's cap rate is 10%, then that asset's going to be worth $1 million. Take that asset, renovate it, improve operations, improve the margin, increase the nightly rate, and you could probably be looking at tripling the income within 2 to 3 years. So let's say now you're at $300,000 a year in income. That asset is now worth $3 million. You just forced appreciation through good operations, $2 million. Wow. And that was the magic of it. So now you're acquiring a business, because you're acquiring a business with the business license, with the hotel license. You're acquiring the underlying asset, so you have real estate involved. And now you can operate it and use the exact same things, the economies of scale, proper management, good digital marketing, everything we do for businesses to basically force appreciation and then either cash out, refinance, or sell the asset.
I love where we're going with this. And I think before we keep going deep into the hotel industry, I'll say, or the boutique hotel niche, I'll say one thing that I want to highlight is like, you can learn, like we all probably learn through these different ways. We got podcasts, we got books, and you and I, we also like to go to all these different masterminds. And people still like, sometimes they ask me like, why do you go to all these events? It's obvious, like we get value, we connect with people. But is there anything that you can remember through that journey that you say like, this is when I realized like boutique hotels? You read about it, you went to the conferences, but what was the catalyst for you to say like, all right, I gotta pay attention to this? Obviously the math, but anything else, any other resources that you saw that was?
Yeah, so originally, as soon as I exited my Airbnb portfolio and I had seen now all these limitations, like the writing on the wall, the regulations, the issue with actually getting these properties to sell as a business as opposed to just the value on comparable properties. So when I started seeing all these red flags, I'm like, man, I really want to stay in this industry, but I can't keep doing Airbnbs. I don't want to relearn a whole new industry. So the first thing I did after I sold, I'm like, okay, I'm going to start acquiring businesses. And I'm starting to look into this big opportunity. There's something you're doing, right? But at the same time, I'm like, man, but I want the real estate. I want this real estate involved. And I was looking online, looking on YouTube, and I stumbled upon boutique hotels and the name on the YouTube video, commercial Airbnbs. And I looked into it and I'm like, man, this is perfect. Because going back to like what we were talking about before, I already know there's demand. I'm acquiring a hotel that already has income, not to its full potential, but it's not like an asset that I'm buying that's not even making any income. It already has reservations. It has booking history. It has everything. But you know that it's not at its full potential. Why? Because it's an asset that hasn't been renovated. The owners are your mom and pop operators that might not even have a website. They don't know anything about digital marketing. They don't know all the stuff we know. So you know this asset's already doing 100K. It's like, wow, like there's already existing revenue, demand, and income. As soon as you acquire, you're already cash flowing. So I'm not starting from scratch. I'm not like trying to launch this new product or idea or this new software, seeing if I'm going to get users and seeing if this is going to work and dumping all this money into something that's not cash flowing. I'm already buying a cash flowing asset, but I know through my research that occupancy, nightly rates, operations, marketing is not on point. And that the moment I do these things right, there's all this other upside that I can later use to have an exit, right? So I'm always buying now with the exit in mind. I think that's super important. Like for anybody starting out, it's like you buy with an exit in mind. And it's even better if you buy and build on top of something that's already working, that has been running for years, and you're not testing the waters. Why would you have all that risk, unless you're like the Google? There's no point in running so much risk.
Now let's talk about like a specific example with hotels. Here's what happens, right? Like I know about business acquisition. This podcast is all about business acquisition, and I love them because of what you said. The caveat on that is heavy on operations. It's typically like owned and operated by the person that it's doing the acquisition, which is great for me right now. Yeah. And for the people that are listening that are doing these deals. However, I think that the bottlenecks becomes how many businesses can I operate? Yes, you can go buy larger businesses with management in place, but then you start tapping into the next tier of businesses. So I think the sweet spot is 1 to 10 million revenue, 500K in EBITDA, in SDE, EBITDA, net income, whatever you want to call it, all the way to 2 million. That's the sweet spot. Anything above that is private equity, is very complex and very competitive. What does that look like for your industry right now with hotel? Here's why I'm asking that question. Where I want to go is like, when I look at real estate or even hotels, I haven't looked into it and I want to definitely go more in detail. I was like, this thing is, like you say, $2 million or $1 million and only produces 100K. So that's probably like, I'm probably missing something in that equation, which what you say, the renovation and the output and the multiplier in going from 1 million to 3 million. But specifically to just unpack that question, what are the nuances or the differences there in those two models?
Between boutique and like normal acquisitions?
Yeah, or even just like the why is it that you're investing in something so big and you're gonna have still to pay that debt, but the net income is so small versus like, again, the business acquisitions, like you get all this massive margin, but then I have to operate it. So is it because the hotel already has management in place, or why is that?
You're saying why does a real estate asset or a boutique hotel that does 100K, why is it worth $1 million?
Let's start there. Yes, but there's more. I'll say
versus like your standard business, which is 3x
Correct.
multiple on your income.
Which is similar then.
So in a normal business, say a dry cleaning company would be worth, or marketing company would be worth 300K.
Right.
That's doing 100 would be worth 300.
Right.
This is worth $1 million.
Yes.
Well, real estate has the underlying asset, which makes it where the multiple is going to be a lot higher.
So that's the question though, because and again, I'm asking like probably some people in the show as well, but I don't know anything about the industry. It's like some of the business acquisition that I know of is typically, oh, there's a building, and the number one question that I see in the groups that I'm a part of is like, can we just not buy the real estate? They don't want to have the real estate involved because the business is not the real estate. They just have offices and they rather just carve that out.
Mm-hmm.
But in this case, the business for the hotel is the property.
Exactly.
So,
That's
but the
business.
property, can it be value outside of the hotel? You don't want to do that because
there's different ways to value like a commercial asset. Sometimes when there's no income on it, then it's an asset-based sale. So they look at comps like how much have other hotels in the area sold, price per door, and then it can also be done that way. So $20,000 per door and you have 20 rooms, they multiply, and that can be a way to do it when there's no income, right? And then there's the income-based approach, which is you're taking the income and then you're assigning this cap rate, which in the business acquisition terms, it's just a multiple.
Yep.
Right.
Okay. And then where I was mentioning like the sweet spot for small business acquisitions, 1 to 10 million. Have you seen a similarity in that industry where it's like, well, above that, you got the big players? I think we were talking to somebody a couple of weeks ago about that, like hotels, like big players in the US. They're like really fast. They're using data driven like you like. They're using AI to analyze thousands of deals. They're making off-market offers.
Right.
So like, what's the sweet spot for you?
Yeah, like, I mean, I think most of these larger firms are looking at bigger hotels. So they're not really touching anything that's like less than 100 units or something. So we're staying below that. We're like 20 to 60 units more. You're really boutique. Where for these larger companies, it doesn't make sense. Like they want to be making millions in revenue for it to make sense. For us, like we like these smaller deals, and you can still make millions off of them, but there's not that much competition if you stay between that sweet spot. So kind of like the same as like business acquisitions, which you were talking about, works the same way.
Yeah, beautiful. And then the search process is also very similar. You mentioned before we started recording that you're looking at dozens of deals. You have an analyst team that is looking at deals left and right. It takes a lot of work. I think the average people in the show, they look at about 100 deals even before finding one that's like, that's the one. Some people I look at 300 deals. I look at 120 deals in 2 years. So tell us a little bit more about your process, looking for properties and all that process.
So obviously there's on market, Crexy, LoopNet, and all of these commercial real estate sites where these hospitality assets are listed. But usually when they come on market, they're the deals that the broker sent to their internal list and nobody wanted.
Wow.
So that already is like a red flag. I mean, I'm not saying you can't find deals on market, but you should always look into like, why hasn't this sold? And why has it been 6 months or a year? And why didn't this sell to like their private list of buyers? And why is it sitting on market? Maybe the reason is just price. I mean, sometimes these sellers want too much for their property. And eventually after it's sit on market for a while, price starts decreasing. So you can find deals there. You can maybe do some creative finance, seller finance the assets and make a deal work. However, we're finding that, and we've analyzed and underwritten over 300 deals at this point on market. Like anything that fit our buy box, we've already underwritten. And we're finding that our delta between the asking and offer price of what we would offer is always like at least 50%, right? So we're too far from what they want. We're still sending LOIs and we're sending like, hey, this is what we can pay. Let us know. If not, all good. But really, what we started doing now is going off market. So we have a list of 5,000 hotel owners in the top markets that we're buying that we want to basically be establishing a relationship with. And we're hitting them with SMS. We're hitting them with postcards. We're hitting them with emails. And then we're calling them, right? So off-market sellers, and then we also scraped the top brokers in each market that had the most transactions. That shows us that they get a lot of deals, And now we also sent them mass email marketing campaigns, text messages, and we're calling them to establish a relationship with them, let them know that we're buying, let them know our buy box, and asking them if they have any leads. So now we have on-market leads, we have our off-market, and our broker sending us leads. And that gives us enough deal flow every week to be analyzing deals through our pipeline.
Yes, that sounds like a lot of work. And that's probably the added value that you have when there is a fund, which will go there next. And when people say like, I want to get into that, but I have no idea, I don't have the time, I got the capital. So that's the next tier that we're going to be discussing, is the investment vehicle of this. But let's keep diving into more of the example that you were sharing. You got a property that is $1 million, is you say 100K in income, and then cap rate is what, 10%. Do you have any references or any historical data on deals that happen the way that you want to do it? Meaning, what you said is you get it for, how much would you buy that property for example? Like you say, it is $1 million, or okay,
$1 million.
And give me an example on finance. What would the deal structure will look like? Are you taking a commercial loan for the whole thing, or?
Yeah, so usually the strategy is, or our strategy is, we're buying a property that needs some significant amount of renovations. And I mean, it can be cosmetic, so paint, bathrooms, right, kitchenettes. We're redoing a lot of this stuff. We're also adding a lot of amenities. So we'll if there's no pool and we have the space, like we want to build a pool if it makes sense for that market. We want to add maybe a tiki bar, a bar area, an outdoor cinema, a wellness or spa area. Like we're trying to go super experiential stays, because that's what worked really well for us when we were doing Airbnbs. Back when the Airbnb days, we were doing 6-bedroom properties that had a game room we could convert into that had a garage we could convert into a game room, master closets we would turn into like a spa with an infrared sauna, and then the outdoor area, it was lakefront. We would add a fake beach, tiki bar, outdoor cinema, volleyball court. So these were like your private mini resorts for families and big groups to rent. Now, we know this works, and that's the model that we want to implement into the boutique hotels. It's highly amenitized, highly personalized, custom experience, because your flag hotels, they are very cookie cutter type, right? We want to appeal to all the senses: sight, the smell, the touch, everything from when you enter the hotel, what type of music, what's the ambience, what's the smell, right? The feeling when you like get into the bed, and like the soap, like everything is going to be very well thought of from like a design and marketing perspective, right? Now, once we do that, we're talking now economics, right? You asked me about how to structure this deal. So say the deal's $1 million. Say we invest $500K to renovate it. We're all in $1.5 million, right? We usually, what we do is we want to get a bridge loan or some short-term debt to do. We bring some of the equity, right, from us or our investors, and then we'll get, either we raise all the capital as equity, depending on how big the deal is. We might not get any leverage on it for the first 2 years, right? So we might raise, say, the 1.5 as equity, or we combine a private lender or a short-term or a bridge loan with the equity that we bring to the table, so that we can renovate the asset, operate it for at least a year. And once we have 1 year of financials, we can now go to a commercial lending bank and get some long-term debt, usually for 10 years. But now they're going to value the asset based on the new income. So if now we can show, hey, look, this asset did 300K net operating income last year. Take that 10% cap rate again. So 300 divided by 10. Now they're going to say, yeah, that asset is worth 3 million. And they'll give you a loan based on that 3 million. You might need to leave like 20% equity in the deal, but now you can cash out of that 3 million, 80%, right? So you're actually made all your initial capital back, and you might walk away with more capital than you put into these deals. So you can return all the investor capital back. Now investors got all their money back plus a return. You're in for $0 in this deal. You can recycle that cash to do another deal, and you can keep cash flowing this asset for as long as you want. Maybe it makes sense for 5 more years so that you can finish executing your business plan, because in a year, you might execute a couple of the strategies, but maybe you didn't have time to do everything. Now you can bring in influencers and do some influencer marketing, right? And you can keep increasing that income to then get a second exit. Because the first, you can consider a refinance the first exit. It's like you're exiting, but you're still holding the asset because the bank is already valuing your asset at the new price. You're pulling capital out. So you're exiting the business, but you retain management. You keep managing it. You keep improving operations. Maybe you improve expenses, marketing. Maybe you're able to, I don't know, like get it to be more trendy and do some PR campaigns or work with like influencers. Now you keep improving the income. Say by year 5, it's making $500K net operating income. Now that property is worth $5 million. So you refinanced out in year 1 or 2. Probably need 2 years because you need at least 6 months to renovate plus another year to operate. So refi out year 2 and then have an exit year 5.
Wow. So no, I love how deep you went there. With that is a thesis, right? You launch a thesis. What's the worst case scenario, like the risk that you have where you got the bridge loan and you don't increase from 100 to 300? In fact, because you renovate it, income goes down. Like, what will be the alternative in order for you not to go underwater if you cannot go refinance, or you don't, for whatever reason, the bank says like, no, you're not ready, or what is the obstacle or the challenge to overcome at that stage?
Yeah, so that's why you give yourself at least like 2 to 3 years on that bridge, or you raise all equity and you buy all cash. That way you don't have that time constraint or that time pressure that you're paying this loan. But usually you give yourself 3 years and you renovate within 6 months. Max, it takes a year because of all these delays. You still have 2 years to get that property at least to 100K back to where it was. There's no reason why it can't do the same it was doing. Once you renovate the asset, it's a much better asset. If it was already doing that, like, why couldn't you be doing the same amount, like at least that same amount? So as long as you're able to do, say, 150K, that asset, it's already worth 1.5 million, right? So you're at least, when you go and refi out to a commercial lender, you're going to be pulling some capital out, right? Maybe not all of it, right? If this is executed perfectly, you get all your money back and some. You walk away with more money than you put in the refi. If it's not done well, the worst thing that can happen is you just have to leave more money in the deal and the bank's only going to lend you less. You still pull out some cash and you're just going to have to execute the business plan accordingly so you can get an exit at a later point and just keep cash flowing it, right? Obviously, there's always risk in all of this. There can be another pandemic, right? But we're always trying to limit our downside, and we're protecting ourselves. How? We're buying deals where if it's making 100K, we know that it should be making at least 5x that. Why? Because we're looking at the market comparables. So what other hotels are doing in that area, close to what our vision is, what their occupancy is, and what their nightly rate. So we know, like, hey, if we can bring like, and we're not underwriting based on like pushing it to the max. We're underwriting like conservatively. If we can increase nightly rate by $30 and we can increase occupancy by 10%, and we're doing these sensitivity analysis to like, no, all right, this is our risk. This is best case scenario. This is worst case. And we're always like underwriting and trying to purchase all of our deals based on the worst case scenario. So there's still so much more upside than what we're really underwriting with or promising to our investors. That's like we're trying to be super conservative on that.
Yeah. Since we're there already, I'm gonna pull up. I just try to do some math with you and like just see where we get with that example, and we'll move on to the next most important part of like the investment side of thing, right? Like the fund and raising and deploying capital. But I think this is part of the whole conversation. For that $1 million deal, let's say that somebody takes over this deal, not you and your group, somebody that is not really into the business. They say, hey, I'm just going to buy this property. They do all equity. And then they say, out of that $1 million, the valuation came from the hotel industry, but maybe the property itself is not valued at $1 million. Is that the nuance difference there is like the building itself it's not worth $1 million, is it?
Again, like there's transactions that are being done as like an asset base.
Right.
You see this a lot in like Florida, where these sellers are asking for prices that are outrageous simply because they're in a really hot market. So they might be making 100,000, but they're asking for 10 million only because they decided to now value this asset based on price per door in their market and because they're in a really hot market.
But the commercial bank, it's also playing that game. It's different from like the startup people that are saying my company's worth whatever based on a future thing. The bank is actually backing that up and saying we will lend again, not to the highest.
They will do an appraisal, and you can order like they can either order an appraisal based on like the asset or based on income. So they'll always have like the downside protection. Like they'll look at income. If there's no income, they can finance based on the asset. But a lot of these times they're going to be valuing it not even close to what the seller is wanting to ask. So it's really hard to make these transactions work. And that's why a lot of these sellers have their property sitting on market for ages, is because you ask them for P&Ls, you ask them for financials, they have nothing, or they're not making anything. Or a lot of these mom and pops have been taking cash and they are not even reporting that. So they have nothing to show for, but they're like, I still want 5 million. It's like, we can't get a bank to finance that, like, so there it's when you can get creative and maybe do seller finance. And if they're willing to work with you and they own the property outright and you want to pay them that 5 million because you still see the upside and you think that asset can do so much more, then that's when you need to get into other creative finance strategies and look at a way to make that work. Because bank is not going to just like, give you the 5 million for it if there's nothing to show for, right? But it happens a lot in Florida. I mean,
that makes sense. I think the last part to wrap up, what the math I wanted to do is for the $1 million deal, you're not going to go to a bank. A bank's not going to loan you on that before the renovation if it has like $100K in income, or will they actually lend you $1 million to go buy that property? They wouldn't do that. They only will do it when you.
They would, but think about it like this way. First, you got to check that there's no prepayment penalties. A lot of these banks will have like a clause in there where you can't pay it off that quick.
Are this like 30 or 10 years long?
10 years. Commercial is usually 10.
Okay.
Right? So check for prepayment penalties. But also when a lot of these loans, you're paying principal plus interest, so it's killing you. Whereas in some of these bridge loans or short-term debt, you can negotiate interest-only payments, which really helps ease off like that cash flow that you're going to be burning through while you're doing the renovation, right?
Yeah, I think that's where I got the whole thing before. When I look at this like 4 years ago, it's like, how do you pay $1 million loan that has a 10-year maturity and with $100K in cash flow? Like, I couldn't wrap my head around it. But even at $3 million, if the building, the whole boutique hotel is valued at $3 million, and you got to pay the bank that, like, what is the typical like monthly payment for something like that? If we run some numbers, for example.
Well, it increases. Well, that's why you're always modeling out that the cash flow can cover, it's called the debt service coverage ratio. And you want to be at least 2 times cash flow versus that debt to be on the safe side. The more, the better, right? Mm-hmm. You never want to be in a position where you can't pay the debt. But that's where you're underwriting these deals and you're looking at month over month over that 5 or 10 year period that you're going to be cash flowing the asset. And in your financial model, in year 2 or 3, when you go cash out refi, you take on more debt because yes, now you're not, your initial was $1 million. Yep. Now your new value is $3 million, yep. Right? So your loan is increasing, but since your income increased as well, that's what you need to see. Once I refi out, can I still cover that monthly payment? And say we do a really good job. Say our property is now valued at $5 million. Right. But maybe it doesn't make sense to pull out all that equity. Maybe you keep some of the equity in it so that your monthly payment's not going to increase that much and you don't pull all that capital. It just depends. Like, you need to model this out, look at it month over month. And as long as your debt service coverage ratio is good and healthy above 2.53, and you see, like, that's what you do. It's like you're trying to make sure that you're covering that debt to be able to know, like, how much can I pull out and how much equity do I really need to leave into this deal to be able to cover that monthly payment.
Yeah, that makes sense. I get it. I got so deep into it because that's the thing that the most complicated piece of equation. But like you say, model it out, forecasting, and math doesn't lie. So you'll find the numbers. So that's great. Anything else you wanted to cover in the boutique model specifically? So we move to investing and the scaling the investment side of things.
I think we've covered it, man.
That
Unless
was
you got any other questions.
No, that's pretty good. So investing now. Clearly, there's a lot of work identifying the property, rehab. Is it typically called like flipping hotels, or people don't like to use that at all? Like that model, it's like flipping a hotel.
Well, a flip would be I buy the hotel, renovate it, and immediately sell it.
Right. True. Okay.
I'm buying the hotel, renovating it, operating it, stabilizing it, and then cash out, refi, or sell it. But it's
somebody's gonna come up with a weird name.
It's a BRRRR, like the
that's what I was gonna
rent, rehab, repeat. The bigger pockets came up with this name. Like they talk about it a lot. I think that's what the strategy would be.
Got it. So you're gonna come up with the name for hotels and then coin it and be in your podcast, Freedom Best. We'll try the way. Tell us about your podcast before we go into investing.
Yeah, man, that's the idea next year. It's start a podcast and start interviewing a lot of the entrepreneurs that I know that have a really cool journey to share. I've done a lot of networking these past couple of years. I'm part of a couple masterminds, and I think there's a lot of value and a lot of education that is not being shared that should be shared by a lot of these people that I know. So the idea is to share that journey next year.
Amazing. Well, let us know, and we'll definitely link it right here in the show notes with investing. So the show is Invest and Scale. You have done quite a lot of investing in the past couple of years. You invest in yourself, most importantly. You invest in these masterminds. And now you're building this investment fund. What does that look like? Who are your ideal investors? And what are you scaling? Because the investment fund is typically to scale something.
Yeah, so at the stage I'm in, if you want to go big in real estate and like really start seeing some traction, it's pulling capital. Right. So the idea behind our fund is I'm going to be raising from other entrepreneurs in my network and just people that I know that I have connections with that need real estate in their portfolio. It's not a secret to them. Like they want this, they seek it, because at the end of the year, if they don't have it, they're going to be paying all these tax bills that they could have prevented if they had real estate assets. The good thing with boutique hotels is that you can do something called accelerated depreciation, which helps you depreciate the asset much quicker. Instead of 30 years, you're on 10 years, and you can deduct everything like furniture and fixtures and all this stuff even quicker. So you can be taking huge tax deductions up front to offset all your business income. And since I know the e-commerce world so well, I know all the ups and downs, the issue with just having one single source of income, no passive income, right? Like I'm basically going to my network, like they want this. Like it's a path for them to still be able to focus on their business, get tax deductions, and at the same time have a secondary source of passive income every month. They're just collecting that paycheck. So it's a win-win for everybody. Like we're able to buy bigger, larger assets to cooler projects. They're able to invest passively into our fund, not have to worry about tenants, toilets, guests, nothing, and be part of a bigger project. Because say you're an entrepreneur and you're like, oh, I'm gonna go do this real estate stuff. You buy a house, now you need to manage everything because it's not big enough. You're buying yourself a job. That's why it's good to pool capital so that you can set up these assets that have on-site management, a property manager, a maintenance guy, a cleaning crew. If you were to do this yourself and buy one single Airbnb, you're going to be buying yourself a full-time job. Now you have to manage the guests, manage the cleaners. You're not going to be able to have a full-time cleaning crew or have a full-time maintenance guy. You have to pay everybody by the hour. you're buying yourself a job. So by pooling capital, we can do larger projects that have enough revenue and volume to have a full on-site management team, right? So economies of scale.
Yes, absolutely. I love that. And what are some of the projects in the next couple of years that you will want to invest? Is it you have a specific range of size of hotels, or what does that look like? What's the criteria for the investments that you guys want to make?
Yeah, so really at this point, it's my third venture. Like again, the first business I was doing, wedding gifts, I wasn't passionate about. I was just selling this to try and make a quick buck, make some money, right? Then I get into Airbnbs. Really cool. I'm more passionate about this, the design, the experience behind it. And that's when I was like, man, like I really love working on projects that are cool, that are creative, where I can unleash like my skills, my marketing talents, my creativity. So I don't want to be doing any project where I am not excited or motivated by. Like I could buy a rundown motel, improve operations and be cash flowing it. And I mean, you can make money, but I'm not after that. Like now the projects that I want to be investing in is like super cool locations where our investors and I would love to spend a couple months out of the year in, where I would see myself actually being there. If I don't see myself like visiting that hotel and like staying there myself, I don't want to be a part of it. And we want to combine some of this boutique hotel stuff with some of this glamping and unique experience style resorts, where we can add some tiny home, some tree houses and some cabins and some really cool stuff. Leverage the existing operations of the hotel to actually expand. So we've been finding a lot of these properties that actually have like they have their own private lake and they're sitting on 10, 20, 30 acres. There's room for expansion. There's room for growth. And I want to be working on projects where there's space for amenities, space for creating this resort style, this wellness space, right?
You can do events as well, like weddings and everything?
Wedding events, okay. Wellness, spirituality retreats where people can really go and like disconnect. Like I want to be doing really cool projects where it's like, if you ask me which properties we have in our portfolio, like I'm going to be pulling my phone, like showing you how cool these projects are. Not like, oh, I don't have photos of it because it's just a rundown motel and I don't know which corner, you know, like there's plenty of ways to make money. But at this point, like I only want to be in stuff that excites me, that I want to be behind on. So it's going to be just super cool projects, and they're going to be really unique and experience driven.
Absolutely. So that ties into kind of the last thing to start wrapping up. It's more the mindset. I think you're very passionate about it, and you're also telling me like there's some fire, some excitement about like where you set your mind. That's the key word, like mindset. It seems self-explanatory, but it's not. It's like setting your mind into the right focus, the right objective, the right people. Like tell us a little more about like what is that for you now?
Yeah, I think mindset's probably the most important thing we can do for ourselves. And if you want to be in business, like you need to start working on your mindset first, because you can be doing everything externally and like you're pushing a boulder up a hill if you don't start with your mindset first and going inside of yourself and feeling what that future you looks like, acting as if it already happened, and really feeling those emotions of gratitude, feeling that abundance. And the moment you start doing that, you start seeing how everything's just much easier. Connections start coming in, opportunities flow to you. Instead of you trying to like go after it, like chasing, like when you go inside, you start seeing everything just unfold in front of you. It's pretty crazy. So like, I think like working on that mindset and like actually visualizing and seeing yourself how you want to be in a couple years and believing in that. Because if you don't have the confidence, and you might have some goals, but you really don't have the intention, you don't have the emotion, you yourself don't even believe you're capable of that. And then you're waking up every day and you're just working hard, but you yourself are sabotaging your success because you don't even believe in your goals. You set them, it's easy to write them down. But you can write them down, and then like the problem is like, do you really believe in those goals? And have you felt how those goals would feel like when you have them? Like, think that's like a big key in this journey is like that mindset.
Love it. Absolutely. So last 5 questions, rapid fire style. You love, reading, listen to podcasts, all of that. Give us some of the latest resources that you've been enjoying, either podcasts, books, or masterminds that you're part of.
So every week I watch the All In podcast. It's these billionaires.
That's a good one.
Really, really good one, man. That's my go-to every single weekend. As far as books, man, there's so many I've been reading.
You sent me a couple ones.
Yeah, my goal this year was to read 15 books. I'm at like 32 right now.
Wow.
I want to end 35 this year.
Audiobooks?
No, just reading Kindle.
Wow.
So yeah, the Surrender Experiment was incredible.
Okay.
A happy pocket full of money.
Did you notice like this guy, the Surrender Experiment, it's all business acquisition? Like he bought all these businesses and got the FBA knocking on his door.
He like scaled like this $1 billion company, and he's the author of a couple other books. What's it called? The Untethered Soul.
Art of
like,
Letting Go.
I had read like all his other books, and I'm thinking like this guy's just like a spirituality yogi coach, and like out of nowhere he's this like incredible business guy, and at the same time a yogi. Incredible book. Dude, there's so much. Buy Back Your Time by Dan Martell.
That's good.
That book was super revealing. It showed me like where I'm spending my time, where I shouldn't be spending, and things that I needed to delegate more. That's when I hired my executive assistant, Game Changer, right? So yeah, plenty of books.
Absolutely, man. Well, and what's the best way to connect with you?
You can add my social media in the show notes, but if you want to visit our website, I have a book as well that I wrote on short-term rental secrets. So everything we learned through our years of operating these Airbnbs and going into the digital marketing, how to rank, launch these assets. You can find that at freedomvestcapital.com/STR secrets.
Let's go. Absolutely, man. Dude, thank you so much for this time. And like next podcast, we're going to record in one of your hotels.
Absolutely, brother. Thanks for having me, man.
Thanks.